Ladies and gentlemen, welcome to Destination Retirement with Robert Kuhn.
Time to get on board with Robert Kuhn from Kuhn Capital Partners. Retirement is a destination you've spent decades saving for. And what you do with those savings can make all the difference in the life you live once you get there. Income planning, wealth planning, tax planning. Destination Retirement with Robert Kuhn starts right now.
Welcome, welcome, welcome. You're listening to Destination Retirement. My name is Robert Kuhn. I am the president and founder of Kuhn Capital Partners. We are independent. We are a registered investment advisory firm. And yes, we are a fiduciary. If you've listened to the show in the past, thank you. If you listen to the podcast, please send that on to somebody who needs to hear our message. We try to make sure each and every show is educational in nature. I listen to the other shows on the radio. I understand immediately what they're trying to sell. Here's what we're selling: education. We are selling education to make money and have a strategy, whether it's some or a larger percentage of your portfolio that can do well when the markets don't do well. Isn't that the job of an advisor? So yes, we are financial planning based. Yes, we are always going to take a financial planning stance. We want to run income plans. We want to run tax reduction plans. We want to do all of the financial planning requirements. But at the end of the day, I think our job is to make sure that we craft portfolios that don't simply track the market up and down. That is something that we see by 9 out of 10 investors who reach out to us. And that's just a dangerous game to play. So if you want to get on my calendar, the easiest way to do that, to have an initial conversation to see if we can help you, give Paige a call, 630-492-1912, 630-492-1912. I would love to have that initial conversation. It is complimentary. It doesn't cost you anything. It's just, here's what we do. What do you do? What do you like about your current plan? What don't you like about your current plan? And then see if we can bring something to the table that may improve your current situation. So, in-service withdrawals. We do talk a lot about that. We've gotten many, many calls here recently. If you are still working and you are over 59 and a half, if you're working for the city, if you're working for the county, if you're working for the state, if you're working for a private employer, a publicly traded company, it doesn't matter. If you're over 59 and a half, there is a good chance that you can do what is called an in-service withdrawal from your current retirement plan. That retirement plan still stays in place. It just allows you, the tax code allows you at 59 and a half to take some or all of that money and move it to an IRA. Why would you consider that? Very simple. 401k plans, retirement plans are generally very good to grow money. If we're in a down market, if we're in a slow growth market, if we're in a high inflation market, if we're in a market that is not as crazy as the current market that we are currently in, and we do see the markets drop, there's very little place for you to hide inside of those types of retirement plans. So it may make sense to do an in-service withdrawal. All you are doing is taking the current balance, some or all of it, every plan is different, and moving it to an IRA in your name that now opens up your investment options to, really, they're unlimited at that point. But we open up a Charles Schwab IRA, and then we manage it. So with that being said, please, if you're over 59 and a half and you are still working, let's have that conversation. We know of the companies that allow it, and if we don't have you or your company on the list, we can certainly find out quickly if you have that in-service option. So give Paige a call, 630-492-1912. Last week we talked a lot about lifetime income annuities. And some people didn't like the fact that we're very, very transparent. We're very, very educational in nature. And I think if you look at one of the most, I don't want to say oversold, but strategies that most people don't have a very good understanding of, it's the annuity in the lifetime income space. I want to be clear. We are not against annuities. We look at an annuity, an index annuity, as a structured investment, as a predefined downside, an upside that's defined, and a gain once received that is locked in. You cannot say that we are against annuities because we have a 5-year annuity that fits into our protected growth bucket that gives you the following three items. Currently, you get the first 11.5% of the S&P 500 growth annually. So that's it. 0 to 11.5. you receive. You're capped at 11.5%. It's only 5 years. Once that gain is received, that gain is locked in. You don't give that gain back in future down markets. So if the markets are down, you're not wasting gains to try to get back to even. So we love that strategy. Again, that fits into our protected growth option. There are a lot of investors in the Chicago area that would be very, very content with taking some of their money, given what is going on in this market, and put it into a strategy that currently you get the first 11.5% of the gain of the S&P. If that gain is achieved, that gain is locked in, never to go back down, and your worst year is 0. What we are against is lifetime income annuities for those investors that will never use the benefit. That is what our concern is. I think when you look at the lifetime income annuities, they are sold in situations where the benefit will never be used, and you would be better served putting that money into a growth annuity like the 5-year option, if an annuity even makes sense. Again, we're a fiduciary, so we don't look at only having a handful of options. Our job is to really make sure that we are bringing to the table strategies that can do well in a negative market as well, which we'll talk about the most recent banknotes here in a minute. But the lifetime income annuity, if you own it, I see a lot of $300,000, $500,000, $750,000, $1 million lifetime income annuities that the investor really has no desire to take income from. Because if you think about what you're doing, if you own a lifetime income annuity that is guaranteed by an insurance company, understand that you are only taking your own money out of that investment until the account goes to 0. When that account goes to 0, then yes, you are going to still receive lifetime income payments from the insurance company. How often do you think that's going to happen? Seriously. I mean, don't you think that actuarially the insurance companies know that we're going to give you just enough growth? We're going to limit the income, limit the amount that you can take from that lifetime income annuity each year, that chances are that annuity is not going to 0. So what are you paying for? We hear all too often that, well, we're guaranteed 7% growth, or we're guaranteed X amount of bonus. Well, really you're not, right? Your income number in many instances are what is growing, which is phenomenal. But what value are you getting? Maybe that money should be placed in a 5-year growth annuity, an annuity that can, is there to grow. Because if an insurance company is going to guarantee lifetime income, I've just seen the industry. There's a governor on the growth, period, end of story. There's a governor on the amount of money that you can take out, period, end of story. So what happens with inflation? I mean, think about that. Inflation. Where are you going to be if you're still taking out 5% of an annuity that you owned 5 years ago, 10 years ago, 15 years ago? So inflation is a very big concern of ours. So my concern is not that you want protection. I think that's phenomenal. My concern is that you're just owning an investment that you're going to receive very little benefit of. So if you have a lifetime income annuity, we are going to review that complimentary. We're going to try and see and educate you on if that is the best investment that you should still stay in or place your money into. Maybe a shorter term strategy that has, again, the same protection, just not the lifetime income component, so the insurance company doesn't have to hedge the risk of that lifetime income. Our belief is it's going to give you better growth and a much shorter term. So 630-492-1912. If you own one, let's talk. 630-492-1912. Currently, momentum is the winner in year-to-date performance of the S&P 500. It's so funny that the market, the industry, advisors, they've gotten away from talking about performance. Why is that? So many people are underperforming the market. I talked with a call-in last week. Last year, his return was 3%. Think about that, 3%. And what did the market do? 20-something? So many people are underperforming the market, and the industry has gotten away from talking about performance. Isn't that the job of an advisor? The way that I look at the job of an advisor is to make money whether the markets are up, down or sideways. We want strategies in place that can do well when the markets don't, i.e. the structured notes, the bank notes that we often talk about. And we'll get to that here in a minute, what the current rate is. S&P performance year to date, momentum, 26.2%. S&P, 11.1. Now that's as of May 29th, okay? So the S&P 500 momentum index, 26.2. S&P 500, only 11.1. You know that we often talked about on the radio show why we think the market today is a momentum-based market. The days of trying to find a stock that is trading below its intrinsic value, poring over balance sheets, income statements, quarterly calls, financials, the computers can do that in a second, where it may take you days to do it. So that, to me, we have to look at it again. I think most money, if you want to have the greatest growth with the most amount of protection, you have to be in a momentum-based strategy. And our quantitative strategies that we utilize in our growth bucket and our growth plus bucket are exactly that. Let the computers tell you when you need to invest and when you don't need to invest. When you need to invest and stay into, what sectors, and when you need to put protection on. Again, this is not day trading. This is not trying to guess the market. I'll predict the market. Just let the computers do what they do. And why is that? This next statistic, NVIDIA accounts for almost 43% of the S&P 500's gain year to date. Think about that. One stock, 43% of the S&P 500 year to date. So it's just such a strange market. When I got into the industry back in the late 90s, it was, okay, you have to convince clients that you don't know where the market's going to go. So we have to own large cap, small cap, mid cap, international, emerging markets, growth, value. You have to own all of the style boxes because we just don't know where the markets are going to go. And that may have been right then, but with the evolution of computers today, if you're still working with an advisor that has a buy and hold philosophy that owns all of the style boxes, man, you just have to be disappointed with your performance. I mean, you're not using a cell phone from 1990s, are you? I mean, of course not. We know that. Why are you still using a strategy that, when you look at kind of the risk management strategy, was back in the 80s and 90s? I can tell you why advisors are still recommending that. It's because it's easy to scale. It's easy for them to build a business to increase their personal revenue. That is why. Not because it's the most cutting edge strategy, because I would bet 9 out of 10 advisors, if you ask them how they are managing their personal money, how they are managing their family's money, that it's significantly different than what they are, or how they are managing and what they are recommending to their client base. Why is that? Because when you have, strategies that are just not stocks and bonds, it's relatively hard to implement. We do a lot of dual directional banknotes, strategies that can do well when the markets don't do well. Those are very labor intensive, not on your part, on our part, because our income notes, they're called away constantly. That means we have to reach out to the client. That means we have to talk about a new strategy. That means we have to go over pricing. We have a dedicated employee that's all they do. It seems like that's all they do anymore because of the volume that we do. And again, it means nothing to you, but it means everything to us. And I think that is why you're seeing cookie cutter portfolios from most advisors. And that's just not good enough, especially in a high interest rate, high inflation environment and a slow growth environment, which I think, and I'm afraid that we find ourselves in today. So we have to look at the world differently. After the break, we're going to talk about the bond market. We're going to talk about our latest pricing on our income note. We're very, very pleased with the pricing for the next note next week. So 630-492-1912. If you have any questions, if you want to talk about our strategies, if you want to talk about your portfolio, if you're not 100% convinced that your portfolio can handle and make money in a down market, let's have that conversation. 630-492-1912. Give Paige a call, 630-492-1912. More after the break.
Planning for retirement is kind of like planning for the trip of a lifetime. First, you save and plan every detail. Then comes the day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-492-1912 and visit our website, kuhncp.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn. Yes, we are a financial planning fiduciary. Everything we do is planning based, but I don't think that is why people work with us. I think that just should be expected. I think people work with our firm, number one, because we're a fiduciary. Number two, because we are talking about strategies that can do well and generate positive returns or protect principal when the markets are down. I think if we have to boil it down to the reasons why investors work with us in the Chicago market, it's that. We are at the cutting edge of risk management strategies, tax management strategies, tax reduction strategies. We're going to talk about many of those during this segment. So if you have any questions on your portfolio, if you're not 100% convinced that if the markets were to go down, that you could actually make money with some of your portfolio, let's have that conversation. If you're unhappy with the growth of your portfolio, I can't tell you how many people I've talked with that they have just greatly underperformed the market over the last couple of years. I mean, to the tune of, significantly underperforming the market, and you're concerned about that. Let's have that conversation. Give Paige a call, set up that initial consultation. It doesn't cost you anything. As I am on the radio, I am on our calls. We're education-based. My job is not to try to sell you anything. My job is to give you the pros and the cons to what you're currently doing and educate you on if there are better options. So 630-492-1912, 630-492-1912. We'd love to have a conversation with you. Next week, we are having dinners on Tuesday and Wednesday in Naperville at Morton's. If you do have a net worth for these dinners, the qualification is $1 million or more, not including your primary residence, and you want to learn about how you can greatly reduce your taxable income Tuesday and Wednesday. We do have dinners, so please give Paige a call. Let's talk about that, see if it would be a good fit for you, 630-492-1912. The investment is in the energy space. By any way you look at it, energy investing in the right energy strategy can greatly reduce your taxable income. Last year, had you invested per $100,000, you reduced your taxable income by almost $90,000. Yes, active income, passive income, W-2 income, 1099 income, capital gains, very, very straightforward tax strategies in the energy space. I do want to caveat that I cannot give legally tax advice. It's always a best practice to speak with your tax professional, but these tax strategies are very, very cut and dry, very, very black and white. But last year, per $100,000, you reduced your taxable income by almost $90,000 invested directly alongside the Chevrons, Exxons, ConocoPhillips, Occidentals, BPs of the world. Targeted distributions are in the 15 to 20% range. So if you have any questions on that, if you could benefit from great tax benefits as well as 15 to 20% targeted distributions that are not dependent upon the stock and bond market, give Paige a call, 630-492-1912. Just let her know you want to learn more about the energy strategy, and we can certainly have that conversation as well. The banknotes, if you have listened to the radio show in the past, you understand that we look at the world differently, okay? When we look at portfolio construction, and when we look at crafting a portfolio, again, the markets can go up, they can go down, and then go sideways. That's it. Those are the only three ways the markets can go. Most investors are going to make money in an up market. I'm surprised how many people have actually underperformed the market with some of the conversations that I've had here recently, but most are going to make at least positive returns in an up market. Probably going to lose money in a down market, and we just don't know when the markets go sideways what you're going to do. When we craft portfolios, we want strategies that can do well in all three of those markets. And yes, they exist. It just takes education. Generally, these are higher level institutional type strategies that are not mass marketed, or you're going to see advertised between, in a 30-second or 60-second commercial between a sporting event or your favorite program on the weekend. So it's our job to educate you. If you've listened, you know we do a lot of banknotes. The current banknote that we have is a Citigroup banknote. Again, $1,000 minimum. Can you imagine that? $1,000 minimum on the banknotes. I remember back, 15 years ago when you needed to have $1 million just to invest in a banknote. So yes, technology has allowed this to become what I believe for everyone to own. So if you have an interest, reach out. If you can't get into this one, well, certainly you can probably get into the next one. This is Citigroup backed. So Citigroup, obviously big bank, very, very big bank. Currently is going to pay 12% annually as long as the indexes that it tracks are not down 30%. So think about that. You basically have 30% protection to make 12% annually. Again, very, very good strategy, especially in this market. This bucket of money is positioned for your protection money. Again, your safe money, your money that we want to have predefined, that we know going into the investment what our investment parameters are. So if you would like to receive 12% backed by Citigroup, because it is a bond, I mean, it's a corporate bond. It's just the way the coupon payments are paid is totally different than anything that you have heard of. That's why we're getting 12%. So basically you have 30% protection to make 12. So if you have any interest in that, let's have that conversation. 630-492-1912, 630-492-1912. Because, when I look at, kind of the market, right, we like these adages, sell in May, go away, and, the rule of 72. I mean, there's just so many different little things that sound nice, and they're like nursery rhymes, but they work until they don't work. And if you look at, we have always heard, sell in May and go away, where the summer months generally are slow. Well, guess what? This May was the best performance of the S&P 500 in the last 15 years. That is significant. And if you look at the, if you look at kind of that statistic, there's so much more to unpack in that statistic. But this May was, think of it this way. This May was a very, very strong May. Where many people, if you believed in the kind of the sell in May and go away, well, it was an issue. And, when we look at, this year in 2024, the return in May was 4.8%. 2009 was the last time we had a better performance in May. So how much did you miss out on? And the point of saying this is that when we look at that first statistic, that the momentum-based strategy was up almost 26%. The S&P Momentum Index was up almost 26%, which is really, it was double what the S&P did. So many people just don't think the stocks that are moving the market today can continue. And as we have talked about before, yes, my gut feel says they can't continue either. But what does my gut feel mean? It means absolutely nothing, right? The market doesn't say, hey, Mr. Robert, what do you think your gut feel says? I mean, the market's just going to do what the markets are going to do. That is why we're seeing so much of the equity portion of your portfolio, the growth portion of your portfolio be turned over to momentum-based computer strategies. If you don't have that, if you have an advisor that's trying to pick stocks, that is trying to pick underperformed stocks, diamonds in the rough, stocks that the market is not fully giving credit to, that they think is ultimately going to go up, AI, the computers have already looked at that 1,000 times over. So when you look at what the computers can do, they can just X-ray the market, individual stocks in a way that you and I simply cannot. The challenge is, can you get access to those managers? Well, we've vetted several. We vet managers always, and I'm very proud to say that I believe that we have managers that rank in the top 3 to 5% of all momentum-based managers, and we can bring that to the table. And again, it's years like last year when the market's good, we got to make gains. We have got to make gains because the markets are ultimately going to go down again at some point. Maybe they never will, but at some point, if we look at history, many people who have had these gains that they've experienced here recently, if you don't have a sell strategy in place, which 9 out of 10 advisors could not articulate when they sell something, They can always tell you when to buy something. Very few can tell you when to sell something. Then you're just going to be on that Wall Street roller coaster. You're up, you're down, you're up, you're down. And if we look at the greatest destroyer of compound earnings, it's losses, right? That's one of the reasons that 5-year index annuity strategy that we utilize is so strong, is so, has, just so much interest from listeners, is because it's really simplistic. The math is in your favor. If you know you can invest in a strategy, and again, I don't care what the strategy name is, but if you can invest in a strategy that your worst year was 0, that's it. Your worst year was 0. So if the markets are down 50, you are down 0. You currently get the first 11.5% gains of the S&P annually. That's pretty good for some people. Some people would take that. For your safe money, everybody should take that. But for most of people's money, many people would say, I'll take that all day long for all of my money. So currently you get the first 11.5% of the S&P 500 gains. Once you get that gain's locked in. So you don't have to worry about giving that gain back. The markets are negative in the future, you don't give back that gain. And then subsequently, you don't need to make up those losses when the markets are down because you can't lose money. So when we look at crafting portfolios, yes, we believe for our equity bucket that the computers can do it better. Let's have a conversation about it. Let's talk about a manager that utilizes 50,000 lines of code, that has a strategy that is battle tested since 2000. I think you're going to like the performance because, yes, when we look at statistics like one stock currently makes up or accounts for almost 43% of the S&P 500's gains year to date, at some point it may go the opposite way. How are you going to protect that money? How are you going to realize those gains? Because I know this almost to be fact, because at least anecdotally from the people that I talk with in this industry, nobody has a sell discipline. That's the problem with individual advisors. They don't have a sell discipline. You have to work with an advisor, a strategy that has a mathematical sell discipline. So you're not just riding the market up, riding the market down. And that's what we're bringing to the table. And those are the things that when you look at why I think people seek us out and why we get the reception that we do, it's just because I think we're crafting a portfolio. We're not telling you that our crystal ball is any better than anybody else's crystal ball. But what I am telling you is we are crafting a portfolio that can deliver protection and still deliver growth when the markets are negative. When it comes to the growth side, we are crafting a portfolio that has managers that have consistently outperformed the S&P 500. Isn't that the job of an advisor? And then we have access to strategies that can greatly reduce your taxable income. That is the job of an advisor. If you're working with a big bank or a big brokerage firm, I promise you, on the tax side, there's nothing cutting edge that you are being offered. And if you want to reduce your taxable income, if you sold a business, if you sold a property, if you are a high wage earner and you want to reduce your active income, your W-2 income, your 1099 income, your capital gains, you're not going to get it from the big banks or the big brokerage firms. They just don't offer them. So if you want to have that conversation, let's have that conversation, because last year, had you invested in our energy strategy, you reduced your taxable income by $90,000 per $100,000 invested. Now, a lot more goes into an investment decision than just taxes. So we have to talk about it. We have to talk about what it is and what it's not, and we will do that. When we get back, we're going to talk about the bond market and the 46-month drawdown that it's in. If you want to get on my calendar, if you want to have a conversation, give Paige a call, 630-492-1912, 630-492-1912. More after the break. Welcome back. You're listening to Destination Retirement. Thank you for joining us this weekend. My name is Robert Kuhn. I am the president and founder of Kuhn Capital Partners. We're independent. We're a registered investment advisory firm. And yes, we are a fiduciary. Our job, our differentiation is being able to bring to the individual investor strategies that can deliver positive returns in negative markets. I think that is the job of an advisor. Yes, we believe in financial planning. Yes, we believe in traditional asset management, but we also want to bring to the table a way for clients to make money when the markets are down. I challenge you to find another radio show that talks about that strategy, and they do exist. They're just generally institutional in nature, so it takes some education on my part. but that is what we do. We're here to educate. We're not here to sell you, just like the lifetime income annuity. We're here to educate you. Will you really see a benefit from that lifetime income annuity? Or would it make sense to put that into more of a short-term annuity that gives you more growth potential? Those are the challenges that we are. Those are the concepts, the topics, the thoughts that we're going to challenge investors with. I see far too much investment into lifetime income annuities that you will never receive a benefit. Again, until that account goes to zero, you are only taking your own money out. Think about inflation. Think about low growth that you're getting in that lifetime income annuity. Think about the governor that insurance companies are putting on that investment. So the question is, will there be a benefit for that investment? We're not saying we're against annuities. I've talked an awful lot about the 5-year growth annuity that we love. S&P 500 based, annual based. Currently, you get the first 11.5% of the S&P 500. And once you get that gain, it's locked in. So we love protection strategies. We just want you to be in the right protection strategies. So if you own a lifetime income annuity and you want to talk about, is it the appropriate place to be because you're unhappy with the growth, or you didn't know they put a governor on the withdrawals, and you're concerned about how those withdrawals will not keep up with inflation, give us a call, 630-492-1912, 630-492-1912. So the bond market, if you're working with a traditional advisor, you probably hear many, many phrases. You may hear asset allocation. You may hear diversification. You may hear balanced portfolio, etc. You have to think about, what do those things really, really mean, right? If we're trying to manage risk, which I think is why, people used to use diversification or talk about asset allocation or talk about fixed income as a means of risk management, many advisors today have failed their clients, especially if you're using bonds as a means of diversification. The U.S. bond market has now been in a drawdown for 46 months. What is a drawdown? Losses. By far the longest bear market in history for the bond market. Currently, we started, it's just, we don't want to get into dates here, but the drawdown that we're currently in the fixed income market is significant. People are losing money in their safe money. So think about this. Go back to 2022. I bet you lost money in your equities, and I bet you also lost money in your fixed income portfolio. So if it was just so easy to craft a portfolio of 7 to 10 different investments, and it's going to be able to weather all markets, and the advisor doesn't have to do anything, well, what an industry to be in, right? What a great way. What a great job to be in. Make a ton of money as an advisor that holds yourself out as an advisor that is going to try to mitigate risk, but yet you just simply invest in strategies that go up and down with the market. And then in the bond market, you've lost a lot of money. Many, many firms out there, that is all they do. That's it. They want a balanced portfolio. You're at the mercy of the market. That should not be good enough for you. If it was the only way to manage money, then it would be. I wouldn't even do the radio show. I mean, it just is what it is, right? But the reality is that that's not the case. There are so many ways that you can benefit from negative markets. So I challenge you, if you're managing the money on your own, or if you are working with an advisor, what bucket of your current portfolio, what percentage? Is it 10? Is it 20? Is it 40? Is it 60? What percentage of your portfolio can actually make money if the markets are down? Think about that. What bucket of your money can make money if the markets are down? If you don't know that answer, if you're managing the money, well, you have to answer to yourself because you're the one making the buy and sell decisions. If you're working with an advisor and they have not pointed that out to you, 99% chance you have nothing in your portfolio that can do well when the markets are down. And if you're still using fixed income as a means of portfolio diversification, it's just not good enough. So we challenge you, there is a better way. We talked about the bank notes that we do. Currently, we have an income note from Citigroup that is going to pay 12% annually as long as the indexes that it is tracking are not down 30%. So think about that. You basically have 30% protection to make 12% annually. Great strategy, right? It should be in everybody's portfolio, in my opinion, in some form or fashion. You need protection. You need the ability to make money when the markets are down. Again, there's a lot that goes into that investment. I'm giving you high level. We have to talk about everything, the risks and the rewards of the investment. And that's generally done, if you feel like it could make some sense for you. So give me a call, 630-492-1912, 630-492-1912. Paige will get you on the calendar so we can have at least an initial conversation of what we're doing for our clients to protect their money and when the markets are down, and even see positive returns when the markets go down. So 630-492-1912. Because candidly, you see the same headlines that I see probably. We saw a headline this week on the U.S. banking system. The FDIC warned that 63 lenders were on the brink of insolvency due to banks sitting on $517 billion of unrealized losses. And that's concerning. I mean, that is very, very concerning. And, risk generally happens fast. Risk, happens in a way that we just don't know. That is why the traditional style of managing money was you have to diversify. Well, I want you to think, what does diversification mean? Diversification, I want you to look at your statements. And if you're managing the money, you should know this. If you're working with an advisor, hopefully you have access to your statements. Look at your holdings. I'm going to bet that you may own 10 ETFs, 10 mutual funds, 50, 60 different individual stocks, and you are going to think, I own a lot, so that means I'm diversified. That means that if the markets drop, that I'm going to do well. That means that the markets drop, that I have protection in place. Well, that's not diversification. The number of investments that you own does not mean you're diversified. Now, that means you may be diversified in equities. You may be diversified in fixed income, but go back to 2022. The S&P 500 was down significantly. What did your portfolio do? Did you have investments in there that actually helped you make money to mitigate the losses from equities? Or did you have your safe money also lose money in the bond space? Those are the things that I want you to start to think about, because you just have to. In this day and age, when we see headlines like the FDIC warns that 63 lenders are on the brink of insolvency, well, that doesn't mean that you should be scared. That doesn't mean that you should run and put all of your money in cash, or that doesn't mean you should put all of your money in CDs. That just means what bucket of your portfolio that if the markets did correct, and if the markets did go down 15, 20, 25, 30%, which is, it's not if, it's when, what bucket of your money would still deliver positive returns? I mean, think about that. And if you don't have it, we really need to have a conversation, because you're just not set up for compounding your assets at the greatest amount possible with the least amount of risk and volatility. 630-492-1912, 630-492-1912. That's why we do the radio show. That's the exact reason we do the radio show, because I know far too many advisors in this industry that you are paying for something and receiving no value. If you want to just track the market up and down, then it's really simple. You don't need an advisor. Go sit with Fidelity, go sit with Schwab, go sit with Vanguard, go sit with whoever that's going to give you free advice, that's going to show you how to diversify your portfolio. They're going to talk about 100 years worth of market returns or at market averages, which are over the long term. But again, my thought process to that is, what does that matter? If I'm 55, 60, 65, 70, 75, what do I care about 100 years worth of market data, market averages? Again, market averages, they just don't mean a whole lot to me, because I can tell you that if you bought Microsoft in 2000, it took you 14 years to get back to even. 14 years to get back to even. That's a heck of a long time not to see any growth, right? Now, if you're an astute listener, you may say, well, he's cherry picking data because he's starting with the tech bubble. Well, of course. Well, but where are we at today? Look at the valuations today. I mean, look at the names that are driving the stocks today. Now, today's tech stocks are not the tech stocks of the early 2000s. I mean, there's no doubt about that. But I guess I want to convey to individuals is you don't have to lose money. And that's the job of a proactive, cutting-edge risk management advisor. That's an advisor that is going to use the latest and greatest strategies to mitigate risk. And these are new to you. They're not new in the institutional space. They're just new to you. So we're not going to craft portfolios that are cookie cutter. We're not going to craft portfolios that are easy to implement, so I can just simply go out and raise, dollar after dollar after dollar to see my personal income go up. We're going to bring portfolios to the table that are labor intensive, that take a lot of explanation, that require a lot of back end work on our part. It has nothing to do with you, but they're very labor intensive for us to implement because it's right. It's right for you. It's going to give you the best chance to succeed if and when the markets go down. Because at some point they will. Now, our growth and our aggressive growth strategies outperform, and at least historically, and they've outperformed greatly. Now, past performance is not indicative of future results, of course, right? Those are, what happened yesterday, but we believe with a good level of certainty that they'll continue to have that outperformance unless something changes. But the job and everything I do and why I do this radio show on the weekly basis is to get the listeners to pick up the phone and give me a call if they don't have 100% confidence that if the markets go down, that they will weather the downturn and even make money. Because the job that we have is to compound your assets. That is our job. The greatest destroyer of compounding money is portfolio losses. Do not sit and listen to an advisor say, well, we've got a long-term time horizon. You don't need the money tomorrow. It's like, okay, well, why do I need you then? So 630-492-1912, 630-492-1912 if you want to have a conversation. We're going to talk about the equal-weighted S&P relative to the S&P 500 and what that is showing us when we get back. More after the break.
Planning for retirement is kind of like planning for the trip of a lifetime. First, you save and plan every detail. Then comes the day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-492-1912 and visit our website, KuhnCP.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn. I am the president and founder of Kuhn Capital Partners. We are independent. We are a registered investment advisory firm, and we are fiduciary. We do this show every single week to make sure that we are giving you, the individual investor, which Wall Street classifies as retail. But we want to give the individual investor the same strategies, the same access to strategies, the same opportunity to make money as Wall Street. And what generally that means is we want to make money when the markets are down, because this world is crazy. There is tremendous amount of risk out there. Now, my crystal ball is not any better than your crystal ball, than any other advisor's crystal ball. That's why we rely upon the computers. We believe that the computers and a quantitative asset management strategy is going to produce better returns than just the human eye. But that is why we are doing this radio show. We want to bring to the table strategies to you, the individual, that can still deliver positive returns when the markets are down. Predefined strategies for some of your money. I promise you, we're going to need it at some point. We just don't know when. So 630-492-1912. 630-492-1912. We are located in Naperville. We do have a national client base, so working with individuals in all parts of the Chicagoland area and central Illinois should be very, very simple, considering we work with investors all over the country. With the evolution of technology today, if you want to meet by Zoom, we can meet by Zoom. If you want to have a conference call, we can do that. If you want to meet in person, which we prefer, we can certainly do that. Our office is located at 59 and 88, so very centrally located. If you want to have a conversation, if you want to at least have an initial conversation about our thoughts, our processes, our financial planning, some of the high-level strategies that we do, and what we're bringing to the table, we can certainly do that. Just give Paige a call, 630-492-1912, 630-492-1912, and we will get that set up. So last segment, obviously there's risk, and we talk a lot, and I've talked to so many investors who have missed out on so much and such a large percentage of these market gains recently, because I hear over and over again, the market has to go down. I'll wait till it goes down. Well, that might be what I believe as well, but what I believe and what you believe, respectfully, don't mean a whole lot. The market today is driven by computers. It is driven by mathematical models. That is what it's driven by. You look at some of the best hedge fund managers, the ones that have outperformed the greatest, who have produced the greatest rates of return over time, they're mathematical models, they're quant managers. The challenge is, can you, as a retail investor, as an individual investor, can you get access to those same managers? Or are you working with an advisor that's still just telling you buy and hold, can't predict? I never knew what buy and hold meant, first of all, because just because you have active management doesn't mean you're trying to predict the market. It just means you're putting risk on when the computers tell you to do it, and they're taking risk off when the computers tell you that you need to take risk off. It's not trying to time the market. It's trying to get in at the top, out of the top, in at the bottom, etc. It's just doing what we're supposed to do, which is what we do for our clients. Include strategies like our most recent Citigroup bank note that is a corporate bond, again, has a CUSIP. It's just the coupons are paid differently than anything you've ever utilized, but you have 30% protection to make 12% a year. That's pretty powerful. And those are the things that we're doing. So if you look at, like I mentioned before last segment, if you look at the equal weighted S&P, most people don't realize that the S&P 500 is a market cap weighted index. That means the bigger the company, those returns are going to affect the returns positive or negatively greater than smaller companies. And, if you look at kind of the Magnificent Seven, those stocks, they've rallied over 50%. I mean, so we are a market of a handful of stocks and then everything else. And there's a big difference between the equal weighted index, which all 500 names, their returns are equally weighted, versus the market cap weighted index. It's actually at the lowest level since March of 2009. I don't know what that means, other than I thought it's a great statistic. But if I dig a little deeper into that statistic, it really just tells me that the top 10% of U.S. stocks now account for about 75% of the return of the S&P 500. That is the most since 1930. The market has never been driven by so few names. So the question is that you have to be asking yourself. I bet so many people have missed out on performance because just the people that I've talked with over the last couple of weeks, it's meaningful. And when I talk about missing out on performance, it's not, the market was up 22 and we're up 20. I mean, whatever. I mean, that is what it is. I'm talking about last year the market was up 22% and somebody told me their portfolio was up 4%. And that's an issue, right? So the question is, how long can the Magnificent Seven continue to lead the market higher? Now, it's all fun and games while it's working. I mean, it really, really is. But just go back to 2022 and look at the names that are leading the market higher. Look at those returns of what they did in 2022. And you probably would be very, very concerned. So Again, I know I say a lot of the same things, but that's just our job. If you want cookie cutter basic, stuff, this isn't the radio show for you. Every other radio show on Saturdays and Sundays, you can listen and get that. That's not this show. Our show is how can we bring strategies to you? How can we educate you to allow you to understand that you can do a couple things? You can greatly reduce your taxable income. Greatly reduce your taxable income with investments in the energy space if you qualify. To qualify for those investments, minimum net worth of $1 million, not including your primary residency. Or you make I can't even remember the income requirements. I think it's 300,000 individual, 400,000 joint. But if you meet those qualifications, guess what? We can craft and we can put in front of you investments that had you invested last year, you reduced your taxable income by $90,000 per $100,000 invested. And those distributions are targeted to be in the 15 to 20% range. So if you own individual energy stocks, which almost everybody does, let's talk about this strategy. You get that energy exposure, but you can get significantly greater tax benefits, and the distributions are not going to be dependent upon what goes on in the stock and bond market. Because generally, even if you own an energy stock, if the markets tank, everything goes down with it, right? So we want to help individuals like you know that you can greatly reduce your taxable income. Number two, we want you to know that you can outperform the market if you have the right strategies in place. All right? You can outperform the market for some of your money if you have the right strategies in place. Number three, we want you to understand that you can actually make money when the markets are down if you have the right strategy in place. You can do that. You can protect. You can outperform. You can still make, like our banknote I mentioned multiple times this show, 12% coupons paid annually as long as the indexes that are tracking are not down 30. A really strong strategy. So we're not saying any one of those strategies is better than the other. Here's what we do. We use all of those strategies. That is why people reach out to us. That is why investors work with us. They don't want cookie cutter. They don't want more of the same. They don't want to use 1980s, 1990s risk management strategies in 2024. They don't want to simply track the market up, track the market down. They want to know that for a bucket of my money, guess what? If the markets go down 20 to 30%, I don't like it for my equity money. Now, our equity strategies, at least some of them, have the ability to go to cash, but it's okay, because what if we had 20 to 30% that was protected or even still making money? That's the job of an advisor. If you want that in an advisor, let's have our initial conversation. It doesn't cost you a penny. It's just, let's talk about philosophies. Let's talk about strategies. Let's talk about holistic asset management. Yes, we do financial planning. Of course, we do financial planning. We do income maximization. We do tax mitigation. I mean, the financial planning reports, they're as good as any. That's not why people work with us. People work with us for everything that we talked about during this show. So I want everybody to have a great week. Hopefully, if you want to listen to this podcast, you can go to the website, or this radio show. We do podcasts every week. You can go to KUHNCP.com, KUHNC as in Charlie, P as in Paul.com. Go to the website. If anything we talked about resonated with you and you think somebody should hear it, please just send along our link, and hopefully we can educate them as well. So give Paige a call, 630-492-1912. More next week.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guest unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.